1st of May 2023, Monday. All right, today's Labor Day. I wish you all the best for today's holiday, but I'm still working. I'm still giving you all the market calls. Hope you enjoy this session because this is a must-watch video because the market breadth is definitely very weak right now. Market breadth is very different from market price. So I'll tell you more in details. And to me, the mayhem could be fierce. And this can be very, very critical for people who are heavily invested in the market. Let me share more with you later. But disclaimer apply as usual. And thank you, Ames, for the kind sponsorship. Now, first of all, on the 3rd of May, which is 2 days later, I'll be inviting 4 persons. All right, we have Tony Matnos, Judy Wong, and Wee Lun Teo. All right. One more be from Sharif from the previous draw. All right. And your way, right, I believe. All right. There's 5 of them might be joining me for this coming Wednesday lunch. We're going to be having a Tomahawk King at this Changi Road. All right. You guys have been notified through YouTube. Please check the YouTube posting that you had done and the contact numbers are there. Okay. Now, I think I really like this picture very much. Of course, it doesn't mean it just is a meme, but it's just like that. Because it's pretty clear that the Russian oil is being bought by India, because India don't care, US. But the thing is this, Europe is doing a very smart move. They are buying from India. So technically, the Europe did not actually piss off, or at least in the paper, piss off the US, right? Do you think so? So that is what's happening right now. And to me, that is very smart. And that actually put US in a bit bad shape right now, because now we see China, India, Brazil, all these countries are now turning their back on US in a way and transacting in their own currency. So all this speaks itself that US dollar is a bit of trouble, but overall, in my opinion, US dollar will stay strong. So let's recap what happened last Friday. All right. So the Dow continued to go up and now it has broke above the 34,000 level. Wow, that's a very big jump there. And the NASDAQ up by 85 points, while S&P 500 up by 34 points. Now, across the board, all is good, yeah, from Tesla to Apple to Microsoft was okay, but the one that's lead the limelight, in my opinion, was Amazon, down by almost 4%. So you can imagine if Amazon was up by 4% instead, wow, the Dow Jones will be up by at least 400 points. So we can see that now the market is actually focusing on the big tech's earning, and it's something very interesting because they did come out better than expected numbers, but the market seemingly literally just buying on them. In fact, it's all right. About 79% of the company, okay, of the 500 S&P 500 have surpassed their earnings and sales expectation. But the thing is, this overall is all right. Year-to-year market is actually dropping. So this is interesting here. All right. Although the drop is smaller, but isn't that still a drop? So all I can say is this: market prefer to be watching as versus expectation. So if you bring the expectation down to a very low level and you come out slightly better, the market see as beating the expectation. Okay. Anyway, the main thing is this right now, the more focus point will be on the First Republic, because most likely they may not be able to survive this through. FDIC is actually expected to take over. Yeah. So we know that JP Morgan Chase and PNC are likely going to bid to take over Silicon Valley Bank, okay? And of course, we all know that, right? It's because the bank lost another $100 billion deposits, all right, over 1 month, all right? Of course, that definitely will rock any bank. And hence, therefore, right, they talk about this, why the banks are, why the people are withdrawing money from them. It's pretty clear because the problem comes from the Fed themselves. So we all know that now about 80% traders are anticipating for a 25 basis point rate hike, and most likely there could be one more hike. And that's why I feel that the US dollar at the moment now is still to stay strong until we see the Fed pause. Then maybe the US dollar will dip a little bit. Now, the thing is this right now, this is very interesting. This is within 2 different timing where S&P went above the 200-day moving average before the end of the bear market. Okay. So this is what happened in 1982. The market actually went above the 200-day moving average and then came back down before the market shot up to end the bear market. So similarly, it happened again back in 2001, where the market went above the 200-day moving average for a short moment. Then after that, collapsed down before the big rally. Okay, so what am I bringing this? Because apparently now the market, okay, 2023 is having the same problem, which that the the market is now trading above the 200-day moving average more than for 40 days. Yeah. But then we are still technically in a bear market. So it's very confusing, yeah? The market usually hit the 200-day moving average in a bear market, and then you'll come off before it bottom out and rally. But this time around, right, we are above the 200-day MA, but we are not really out of the woods yet. So this is something very, very interesting. And to me, as a trader, we are all looking at this, watching it very closely. So we'll see how it goes. And of course, you can see the big momentum in the funds going to technology. You can see that the funds in technology came in quite a fair bit. All right, so with the big funds going to technology, we expect the NASDAQ to do well, right? We also expected the all the stock shares, I mean the tech share to do well, but apparently it doesn't move that way, because now the market breadth on the S&P 500 is actually at a very low level. Now, this is something very incredible, because the last time we see something like this was back in 2020, whereby we had a pandemic. In 2016, it's before the Fed actually do the QT. The last time was this in 2009, whereby we have the pandemic. We have the Lehman crisis, and then back in 2000 we have the NASDAQ crisis and so forth. So where we are right now, right, is something that is very puzzling, because the market breadth is so weak, but yet the stock market is that by 5 to 6% away from the all-time high. Something is wrong, right? So what is actually happening right now? Now let's take a look here. Now, first of all, right, growth looking normal because of the steep growth that is happening. So they feel that because things are getting better, the so-called this better than expected numbers are making growth looks normal at the moment. That's interesting. Now, we all know that one of the reasons why the Fed is increasing interest rate because of the inflation. Truth be told, right, the core PCE data in March has went down a little bit, and that's why the market feel that things is going well. But I just want to remind you that March period, right, the numbers are weak because the crude oil, the used cars, the shelters are all going down. But recently we saw that the energy prices going up, the used car prices going up, and also the shelter price are actually stabilizing and also moving up a little bit. So all this tells me that the core PC data could be higher next month. Let's take a look. But the good thing is that the supply chain debottleneck is over. Because why? Because now everything back to normal, COVID is put aside, so things are moving. But of course, the main thing is, can the market really recover? Now, volatility has subsided. Apparently, the VIX itself went below 16 since 2021. And of course, the thing is that all looks good, but I beg to differ. I'll tell you more in detail shortly. Then, of course, the last one is earnings. Now, the earnings seem to be better. First quarter is better than expected. So that's why the market feel that with all these better than expected, things should be better. Okay, so these are all the reasons why the market should be going up. But then the market breadth itself is a big question mark, which I don't really understand, because I feel that, right, that means something is wrong somewhere. Now, let's take a look at the concentration. You can see that over the last 2 months, all right, you can see that the innovation stock like Microsoft, Google, Amazon, Meta, NVIDIA, CRM, they're all the AI stocks, right? So all of them move up quite a fair bit, yeah? But the thing is this, like those in the largest stock that is like 11 to 50, you see they don't really move much. And in fact, like Russell itself, right, look at it, they are not moving much at all. In fact, they're declining month to month. So that means that the concentration on the top 5 techs are the reason why the market is so strong right now. The good part is it basically holds the market. The bad part is, right, that means the rest are actually suffering. So we can see right now, right, with the largest stocks in S&P 500 versus the 11 to 50, right, you can see the top 10 is outperforming the bottom 40. I mean, so-called next 40, yeah? So all itself tells you that the market is being cornered to push up, all right? But again, that means that the economy as a whole is not doing that well. So if you look at NASDAQ versus NASDAQ advance and decline, you can see a very big problem here. Now, usually since from the last few years, they are always in tandem, whereby if the NASDAQ is up, so will be the advance and decliner. But very interesting, ever since the Federal Reserve came in to pump in the $4 trillion into the system, right? You notice that the NASDAQ continued to rise, although the advanced decliner followed through, but it didn't really went all the way in for under 2022. And in fact itself, right, when the peak came in, you can see the advanced decliner has already started to go down. And of course, with the advanced decliner going down so fast, you can see the NASDAQ is forced to go down. But every time when you look at it, right, when you recover, the distance, the spread itself is no longer the same. So now the worst thing is that the advanced decliner is actually still going down while the NASDAQ is going up. Why? As I said for you, it's because they are concentrating on the big four, so big 10. So if the thing is this, if you are trying to just hold a market using these numbers, then of course you are forsaking the remaining. And if these companies doesn't do well, then naturally they will have to file bankruptcy or they can't pay their dues, then the whole thing will have a problem. That's why this spread itself is getting way, way ridiculous. And that's why I'm very concerned that May could be a month whereby there will be mayhem going on. Now, this is the M2. This is really incredible. The M2 money supply has declined for the 8 straight months. Okay, this is not a good sign because we've never seen this since 1960s. It's the first time we see the way it declined is horrendous. So M2 is a measurement of the US money stock that include M1, M1 plus saving deposit and small time deposit under 100,000, and also shares in the retail market by the market mutual funds. So what will happen when that happens? Economy slowing fast, what you're seeing right now, and unemployment will follow, which we are also seeing it right now. So with all these things happens, if we look back into history, whenever such a thing happens, recession is always nearby. It's something that we cannot, deny ourselves. It's always happening. And of course, you can be warned, but if you don't listen, there's nothing I can do, right? So the thing is that for 2023 alone, we have seen 70 large bankruptcy. We have the Bed Bath & Beyond, we have David Bridal, we have Box, we have this Tuesday Morning. All these tell us that these are bigger company, and there are 70 of them that are already, at this stage about bankrupt. So you can see back in 2009, it took about 1 year to hit 118. In 2020, the pandemic time, it took about 1 year to hit 71. But now we are only in May 2023, and we are already having 70 companies that are large enough for bankruptcy. That's about $50 million, yeah? So you cannot imagine in moving forward in June, July, August period where the numbers really to go down lower. I cannot imagine how many more companies will be bankrupted. And to me itself, I'm not even half surprised to see 100 by August. I'm not even half surprised, okay? So right now, take note what I just say, because I think that all this will be happening very, very soon. Okay, so that is the bankruptcy status. And you can see right now the momentum versus the volume correlationship itself is at a very high level. And every time it was at a high level, you can see all the unnecessary attentions on them, like COVID, Fed funds, like earning recession, growth concerns, GFC. So all these speak for itself that whenever things go good, right, market had a way to pull you back. And we can see from here right now, the single stock concentration is really at a very high level. So that means the stock is being bought up on purpose to just prop up the index to make it things looks good. But we all know that what happened next is that when that thing is over, wow, the selling itself can be very drastic, because imagine the big boys are now holding all this counter. They're not basically diversifying. Hence, therefore, once the markets have to take profit, oh my God, things will get very, very serious. So one thing is that we all know that the reverse repo operation is still ongoing, and I can tell you that Fed must have hated it, because now they open a Pandora box for people to actually exit from the banks. So we can see right now, right, who want to invest in a bank where it's so low interest, less than 1%? Everybody wants this 5%, 4%, and the banks are the only few that can actually accept that. So when that continue, it exhibit the bank run and the contract credit when the economy will really get tightened up. So when all these things happen, it's all right, and funds on my hand, where I rather put into the Fed fund rate, because I get my return better than I put in the banks. And of course, that's the reason why now the reverse repo is still mounting up strongly. I'm not half surprised to see $2.5 trillion coming in. Now, the SPX has net non-commercials. They are quite heavily short. Again, my point is it's not too sure why are they shorting the market, because they don't know something, or they are trying to just hoodwink us and actually they are buying. I also don't know. But in terms of data, right, you can see that we are very, very huge in terms of spread, in terms of difference. And then this is actually very, very crazy. So all I can say is this: while we are trying our best to survive, but the economy below us is having a bit of problem. So that's the reason why I came a personal forecast on how I see the Dow Jones the next few years. And I basically use this point A to extend to point B. And I realized that C, D, E are near the technical point. And of course, I believe that the Dow, if you ask me that where the highest you can go, Today, the Dow is at 34,098. I say the highest can go is about another 1,100 points, and that'll be 35,200. I think that's the maximum I can see unless something really changed to the mechanism. Yeah. Now, if the market really pulls back, right, then the support I'm seeing now is 30,000. The support I'm seeing is 30,000. All right. So the downside, it's upside itself, right? I mean, the upside itself is 1,150 points for the upside. But for the downside, wow, this could be big. That's almost like 4,000 points. Wow, 4,000 points for the downside. So definitely, if you ask me, to short seemingly better than the long. But of course, again, you had to come with the context of the indicators giving you the go ahead. Yeah. All right. The thing is this, why am I talking about May? Because May hasn't been the best month. In fact, it's our May has also marked the start of the historically weakest part of the US equity market. The S&P 500 has annualized a return of just 5% from May through October, as compared to 13 from January to February and 17 from November to December. Now, why is that so? Because it's getting hot, and back then what we call sell in May and go away thing is because all these stockbrokers, they're wearing jackets, right? They are very hot. That's why they want to take a break. So that's why they actually sell their shares, get out, take the money, and then take a rest for a while. Then probably coming to June to July period, come back in again. So that is what happened in the past. So now if you look at numbers, well, interestingly, we do have a pretty strong April, but then again, by May, we should see a peak, and that should bring the market down easily by minus 15 to 20%. Wow, that's a lot if you ask me, because we're on a chart here. So all I can say is that I'm not too sure what happened, but I'm telling you this, May may not be the best month. You just have to be very careful. And if you want to buy some VIX, in my opinion, now VIX is near a good buy at 15 to 16 for the cash market. I suspect that you'll go back to 2024, level 2020, going back to this level 24, all right, in about May, June period. And then after that, we see a crazy upthrust to maybe 50 because of the August, September period, okay? So we have to watch it out ourselves, and let's just see whether things will go right, okay? All right. Last but not least, guys, I'll see you on the technical side, and hope you enjoyed this video. It's so important because I feel that if you want to make money from the market, you have to plan it right now. This is Cal signing off. See you then. Bye-bye.